Hello, I'm Craig McCann, and I'm here on behalf of the InvestorsAdvocate.com today to explain to you why I think you should not buy a non-traded REIT. A REIT, or Real Estate Investment Trust, is a concentrated real estate investment that receives special tax treatment if it meets certain criterion. REITs do not pay corporate income tax, and distributions are taxed at investors' ordinary income tax rates. Non-traded REITs can be registered with the SEC and thus sold to retail investors, but are not listed on public exchanges like traded REITs are. As a result of not being listed on an exchange, investors cannot reliably and independently judge the prices charged by sponsors. They cannot act to control and reduce the sponsors' conflicts of interest, and cannot easily sell their shares. Non-traded REITs are poor investments given less expensive, more diversified, liquid REIT investments with the same exposure, such as listed REIT index funds. Brokers, sponsors, and advocates for non-traded REITs often falsely claim that because shares are not market traded, they have low volatility or are stable investments. For example, on the right-hand side of this slide, I have a screenshot from a Guide to Understanding Direct Investments. This is a publication of the Investment Program Association, and at page 9 it says, "Yet the illiquidity of a direct investment can help insulate you against the volatility of the market because it's not subject to daily fluctuations in price. As a result, a direct investment can have a stabilizing effect on your portfolio." That's just not true. In fact, the SEC has instructed sponsors and issuers of non-traded REITs to not make such statements. In December 2011, the SEC wrote, "Some non-traded REITs have proposed sales material that cites their static offering price as evidence that there is no volatility in the value of the security. Unless the offering price is based on a valuation of the security, we object to these statements and instruct these registrants to remove statements in the sales material that suggest a static offering price indicates a stable investment." In addition, in that same marketing brochure that I mentioned on the previous slide, there's at page 6 and 7 the claim that non-traded REITs and other direct investments or direct participation programs expand the asset classes available to investors and allow for improved diversification. This is also untrue. Non-traded REITs exposures are just like traded REITs, that is, listed equities, except they've been repackaged into liquid securities to hide the true costs and allow affiliated party transactions which would otherwise be illegal. Now, first let me show you the types of fees that are incurred at the offering stage in a non-traded REIT. So in this example non-traded REIT, which is REIT 1 from Barringer Harvard, the prospectus shows that only 84% of the sales proceeds from selling the REIT shares will be used to fund real estate investments. 12% will go to pay brokers and their firms to recommend and sell these non-traded REITs. Non-traded REITs, during the period that investors are holding the non-traded REITs, typically pay out a near constant percentage distribution. 6 or 6.5% is quite common, making them appear like coupon payments on a bond. These distributions are made even though the non-traded REITs typically have negative net income or zero or negative cash flow. So these distributions are funded with a return of investor capital or additional borrowing and do not reflect the earnings of the underlying real estate investments. We've studied the investor returns to 89 non-traded REITs and have determined that investors have lost $44 billion compared to what they would have earned if they had instead invested the same amounts at the same time in traded REITs. That what we call shortfall or wealth transfer is made up of three categories of events, loosely called liquidity events. These are when a non-traded REIT is listed on an exchange or is acquired by another REIT. To those two first types, we add a situation where a non-traded REIT is still not listed or been acquired, but has reported an updated net asset value. As of the time of either that listing or acquisition or updated net asset value, investors in the non-traded REITs had accumulated $91.5 billion of wealth. Those same net investments, though, would have generated $135.5 billion of wealth. And so these investors have been harmed $44 billion as of the date of the listing or acquisition or updated net asset value. If we bring those shortfalls forward to the end of June 2015, those shortfalls grow to $46.5 billion at short-term Treasury returns and to $54 billion at traded REIT returns. So we conclude that investors have suffered wealth losses of between $44 and $54 billion as a result of investing in non-traded REITs rather than in traded REITs. We can also express the shortfall, the $44 billion shortfall, in percentage terms. On average, the 89 non-traded REITs that we studied had average returns of 5.6% per year, whereas the same investments in traded REITs would have had an average return of 11.4%. So that amounts to a 5.7% per year lower return on non-traded REITs than on traded REITs. The $44 billion shortfall can also be described in terms of how much of that shortfall is caused by the upfront fees that I showed you earlier in the Behringer Harvard non-traded REIT, for example. We've determined that 58%, or $25.7 billion of the $44 billion in shareholder wealth losses are due to those upfront fees, largely commissions and other costs paid to the brokerage industry to recommend non-traded REITs to investors like you. The rest of the $44 billion shortfall, we believe, is caused by higher expenses that non-traded REITs charge investors compared to traded REITs. And this is because of, largely as a result of payments to affiliates of the sponsor. To show that, we've documented a decline in the expenses standardized on revenue that non-traded REITs incur before and after a listing. And we find that particularly the payments made to affiliates drop significantly after the merger. Final way to think about the shortfall is to compare the gains in total between changes in the market value of the shares and the distributions that non-traded REIT investors have received investing in non-traded REITs with what those same investments would have earned had they instead been invested in Treasury securities or in traded REITs. The non-traded REIT investors as a group have a gain of $16.6 billion, right in between what they would have earned if they had invested instead in liquid, low-risk short-term Treasury securities and intermediate-term Treasury securities, and much less than the $62.1 billion they would have earned if they had instead invested in traded REITs. If an investor wants to have real estate exposure over and above the exposure they have in their home or through their investments in operating companies that might have significant real estate assets, they can acquire that real estate exposure through much lower cost, more liquid investments such as real estate mutual funds, real estate exchange traded funds, and diversified positions in traded REITs, construction companies, mortgage companies, and operating companies. So for these reasons, we strongly believe that investors like you should not buy a non-traded REIT, and that these non-traded REITs are sold to investors like you primarily because the broker who is recommending them to you is receiving a significant commission. Thank you.